So, but I also want to mention that there's a difference between a homeowners association, homeowners insurance, and your home content insurance. So homeowners insurance, you'll get it from insurance, but majority of all banks, when you do apply for a bond, they will actually offer you one because they've actually partnered up with some of these insurance companies when you take up the bond. But what we do find is that maybe 2-3 years down the line, you want to save some money and then you cancel. Some people actually do that. They go and cancel the homeowners, and then when things start happening, your house burns down, you are left with just the house, with just a bond, with nothing to show for it because you canceled that insurance. So it's imperative that you maintain those costs. And with regards to a sectional title, you've got your rates and taxes, levies, and majority of sectional titles, you actually pay the insurance via your levies. So a complex will actually incur those expenses into your billing on a monthly basis. So those are the differences that you actually need to check. So while we're still talking now, back to the scenario that, fine, you were looking for a house, and now there are areas that you actually start searching and looking into. So some of the pointers which I've picked up, and also I know that are influencing in your decision to choose a specific area. One of the conversations I had with Olwam is that I think when you differentiate between a single person and a married with a family, the decision tree changes. Because, for instance, security for all of us would be the same. We all want a secure area. We want to check if there's no break-ins in that certain area that we're looking into. And also things like the amenities, shops around, hospitals. Now, I know this talks more to a family-oriented background. So when you have kids, you're looking for the school, which is closer to where you live. You're looking for hospitals. So if, especially when you still have a little baby, there's closer hospitals, and yeah, and also all other like police stations, nothing is far from you. And then what also that we actually do check is that it is the activity within the area. So is the developments, is the office parks coming up, is the future investments coming up within your area to boost the area. So these are the things that actually also influence the valuers when they actually check the surroundings to say, to score. You know, the scoring is actually, it's not yet fully scientific when it comes to valuation, when the guys value from sent by the bank to score the area. So, but these are some of the factors which actually do actually influence that. And then the churn rate, when we talk about the churn rate, we talk about the activity of houses selling in that current area. So is there a square off, for instance, if let's say you want to buy North Riding, but when you check a property report, you find that in the past 3 years, there's only 3 houses. There's one house that has been trying to sell for the past 18 months. But when you go to Northgate or actually Honeydew, houses, they sell within the first 2 months of buying. So also that you also want to start checking that when you're making the influence of buying, because remember, a house is still your investment. So you don't want to stick around with a house that you no longer need and it's tedious and it's costing you more money, but the area is not actually giving appetite to customers to buy into. So these are the things that you actually would influence you when you're trying to buy a property that I think of should be of value. So what else do what I want to add to actually assist when you're buying? Now with technology, back in the days that we're having, a house is an emotional decision based on emotions. You want to start a family, tired of renting, or tired of living at home, but you want something that belongs to you. So, but now with analytics all around us, So you actually can do your homework. For instance, you can go, take an example, you go to Sandton, you look for a certain property, but you find one in Sunning Hill that you do like, and it's within that budget that you are looking for. So things that you can actually start using when you see that property is that property 24, they are actually selling what you call property reports. So you can see, just sorry guys, I think my so like property 24 is assisting with that so to actually get, for instance, yeah, I took a picture of what it looks like when you want to buy within from property 24. You can buy a property report to get an aggregate, to get the report. But the one that I do like the most, I would always prefer, is you register to this website called Lightstone. So it gives you, so this is actually an example of that property. It gives you very comprehensive detailed analytics around the property. So the previous owners, how much they purchased for, how much the bond was from the previous owners, and also the make of the area. If you see the slide below, for instance, how many, is it more the elderly staying in the area? Is it youth, male and female, which are purchasing, the crime rate? So these are things that you want to, I wish people can start utilizing to check so that they know the kind of areas and not be shocked when you actually do buy and you find that, hey, here, in fact, every 5 days, there's 3 or 4 houses being broken into, but no one actually informed you. So this is the kind of homework that I think people must start doing with regards to.
Lawula, would you please make the main slide bigger than the other ones, because we can see the main slides and the whole list of slides.
Oh, okay. Sorry. Yeah, there we go. Sorry, I didn't know that. Okay. Yeah. So for instance, yeah, as I said, yeah, if you can look, yeah, it gives you the age of the residents, the people that actually recent buys, and also the crime, the residential within the space of time. Yeah. So I'll always prefer, it costs you 150 to buy a report on a certain, for a specific property, but it's worthwhile if, because as I said before, that a house is more of a long-term investment. So you do have to do your due diligence in checking all these areas before purchasing one. And yeah, and then also what, now we talk of the scenario that you've bought the property, you're living in one, but you see that you still want to increase the value because it's a long-term investment portfolio that you're building for yourselves. So some of the stuff that actually do assist in increasing your property value would be renovations. But one thing I want to tell you is that the value of the property is actually calculated the price of a square meter. So the bigger square meters the house is, the more it's valued. So the biggest thing when you actually want to increase is making an extension into the actual square meter size. For instance, a new bedroom, or you include a bathroom, an outside bedroom, or if there was no pool, you include such things. And then also, but to be the best amongst the other houses, for instance, you need to also change the house inwardly. So majority of buyers and what agents will tell you is that first things is that the first maintenance that and renovations you should do internally is your bathrooms and kitchen, because these are the first things customers actually do check. So sometimes you don't have to do much kitchen, you can change the doors and also maybe modernize the taps, you know. Same with the bathroom, change the towel rails and yeah, the shower cap, the shower heads. So to be more modernized, it doesn't cost you that much. And also painting the house, maintaining the house, for instance, when there's cracks, you fix them in time, gutters and everything that is actually, and also now with the new, the current space that we're in, everything being digitized. So for instance, if you can include, hence I said, make it smarter. So you can include smart lights, LED, your LED plugs, and you include, for instance, people actually, well, when you do have money, some are including automated blinds in the house. So that also puts you a par above the rest. And efficiency, same thing, change old light bulbs. There's LED lights now that are coming in, and people are actually moving away from normal stove, electricity stove. They're trying to put gas stoves so that it can be more efficient in saving off the energy as well. So these are some of the things that you can actually start looking into when, and then also, if you actually do buy a property, but it is for investment purposes. So when you do your renovations, it will also assist you when you do sell, because it is called the expenses will be curved off from, it will be rebated from your capital gains. So it's, yeah. So that will also assist you in that. And then, yeah, so, but now, for instance, what I'll touch on here, my last slide, is basically avenues that you can start using when you actually want to buy properties. And we're all looking for cheap stuff. We're all looking for cheaper properties. And the nice thing is that the current market is still biased to the buyers. So owners are still not dictating the market. You can always go in at a lower price. But again, hence my advice I'll give to you is that when I talk about due diligence, is that if there's a property that you see, please check for similar properties as I shared with you from Property 24 and also Lightstone, to check the size and the prices. And that's how, and then you start aggregating for the first three that is recently sold. And then you can do an aggregation of how much you might be willing to pay. So sometimes, you know, customers, you want your own price, and yet the market is saying something different from what you are looking for. So yeah, hence I said there's a lot of emotions when it comes to actually investing in a property. So now these are some of the stuff that I've been also checking on my side. My Roof, the first website which I shared here, this lists all basically repo houses from majority banks and self-voluntary sales. For instance, FNB does list on My Roof, if you're looking for customers which are in distress, thinking they want to sell the property before it actually goes to auction. Or the second option is actually you can visit in your area in Joburg, there's different sheriffs. I'm in the West Rand. So in the West Rand, we've got the Roodepoort Sheriff's Office. Then we have Halfway House in Midrand. We have the Randburg, and we've got Edenvale. We've got one in Germiston. So you can always check around those, because majority of all these sheriff offices, they list the houses which are going on auction. So you can, once you probably see something that you like and you visit it, again, go back, Lightstone, check due diligence, how much the price, so how much you'll be willing to pay for such properties. And then with Standard Bank, that's their website here. This one is called Quick Buy Properties. That is from Standard Bank. So also for distressed customers, you can get cheaper price properties there. And then also, when you search under private property, but you just search and further your search with bank sales, and then you will find also, so here you can always play around, because definitely people are not going to ask 100% of the asking price. So you can always remember, as I said, the market's still dictated by the buyers. I think that's it on my side, unless there's questions from anyone. Yeah, I thank you for your time.
Thank you very much, Lawula. I like when you say distressed customers or property owners, Lord. We're going to have an input from Lazola Momo. Lazola is really someone that comes with a background of BCom Rat, a 4-year degree, and majored in accounting and economics and business. Excuse me, and business management. So he did CTA and also obtained his CA from SAICA after he had done his articles at AGSA, Auditor General. So he's somebody that I've known also for some time. He's actually the acting chairperson of ABASA in the Western Cape and a member of the ABASA Council and Education Committee currently. And he's also holding the transformation position in the SAICA Southern Region Council. And Lazola is at CapeNature currently. He's serving there at senior management level and dealing with internal controls and governance matters. But I wanted Lazola to sort of give his input and his financial take on the matter. So Lazola, the field is now yours.
Thanks, Olon. Thanks to Lawula as well. Hi, everyone.
Hello, Lazola.
I'm just going to share a few of my slides.
Okay, let me then make you host.
Okay.
You should be able to share though. Yes, it's coming on.
Okay, cool.
And please give us your main screen. Thank you.
Okay, yeah, guys, mine is really just to share on managing the mortgage bond and also other debts, because we know most cases for us, it's not just the mortgage bond that we have. We're still paying off our cars, we're still paying off on the credit, and we're still paying off on accounts. So what Lawula really said is key in before buying, actually get rid of all the other small stuff so that you have room for all these additional costs that you don't really hear about. So the first thing is just, I want us to understand what is it we're getting to when we're buying a house, and also how the mortgage bond works and how we deal with other debts as well. As you would have probably heard Lawula speaking, you're like, okay, some of this stuff I do already know. So it's really about principles and values. As much as we get excited and we buy out of emotions, as Lawula has said, but what I really want us to come to understand is underlying everything we do actually, and we do know this, is there's principles and values we need to keep in mind. One is, if you cannot afford it, don't buy it. So Lawula has already talked about how you should sit, gather all the information you need to gather, understand, okay, can I afford it? Is it just the bond installment only, or is there something else? And we know, and we've heard from him, there's other things as well. I mean, especially when it comes to the transfer duty and lawyers' costs. And apart just from transfer side, there's also a bond registration side as well, where you need to register the bond, there's costs involved. And those costs are not factored in that mortgage bond that you go and get to the bank. And getting, what's this thing now, the bond also has, there's other things that come into consideration. As Lawula said, mention some of the stuff that the board takes into account. The other thing is, you might get 100% bond, you might not get 100% bond. And it all depends on how your scoring is. And your scoring is very important. You will see when we look at these advertisements from banks, you will see how they always talk about the dream that you have. they don't really sell what they're actually doing. What they're actually doing is giving you money and say, pay me back. But you don't hear that when they advertise. You hear them saying the dream home, your family and your kids. When you watch the adverts, it's all about seeing you owning the property and living with your kids and enjoying yourself, and not much of what happens financially. What you need to pay upfront, or what other costs are going to be there. So ours today is to say, come, let's discuss and let's understand these. So the benefits, yes, indeed, there are benefits in owning property. Property is key in that property itself becomes collateral. So we know the principle that you don't just borrow someone money, especially someone you don't know. You need to have some insurance or some form of something that you can keep so that you know that person will pay back the money. So the property itself becomes collateral. So that's why property is one of the cheapest forms of debt that you can get, because should you not be able to pay back, we know they'll, at the end, eventually they'll take the property. So the property itself serves as some insurance for them to giving you money to buy the property. Property's got value. Lawula has mentioned how once you've gotten the property, there are certain ways you can increase the value of the property. I mean, some of the costs that come in with getting property is property rates. Those property rates are based on the value of the property. The more valuable is your house, the more rates you pay. Then property is also a form of wealth management. We know we not just coming here on earth, enjoy, and we're done. We have our kids and we need to look after our kids. So one of the key things that I like about property is that, as I mentioned, as a store of value, as you continue to increase and increase your value, that means when a time comes when you need to sell your house, then the value is high. So you sell your house, you get let's say you had bought maybe a 2 million, then over the years, it increases, it goes to about 3.5 or to 4 million. That's about half a million to about 2 million profit that you can make from selling. You can actually use that money that you get, having paid off your taxes. There's always SARS to deal with. But the nice thing about SARS is SARS gives you a very good rebate when it comes to selling your property, especially if it's personal property. That means the house where you stay in mainly, and you stay with your family or other family members, and then they grow up there as well. So they have a high rebate when it comes to that, unless it's property that you buy for business purposes, maybe for rental and so forth. They don't really give a rebate on those, because they, SARS, they want to tax us and they want to make money from us. So I know back in the days when we were growing up and our parents had property, they stayed in that property for long and they wanted property that could cater for us as their children. So you'll find that once the children have grown and we leave, they continue staying in that property, and when they're gone, they leave that property money to us. So what has developed and has happened is that come the time when you're probably retiring and you're old and your kids have grown and they're gone, what most people do is they sell that property and it forms a part of their retirement, because sometimes the pension money is not enough. But knowing that if you sell your bigger property, you can make more money, you can save out of that money, you can buy some equities, then you can probably live on the interest and the dividends from that. So buying property, especially as early as possible, it helps in the long term. So that's more of the wealth management. So in also selling your property later on and making money out of it, one thing that has come into play, especially for people who are into the pension area. I know there's some pensions where, and this is good in terms of helping to pay off your the mortgage bond, which is going to be on the next slide, is that they know that by the time you retire and so forth, you'll probably want to sell, which is probably the trend now, your house, and then downgrade to a smaller house where it's just you and probably your wife living, now that all your kids have grown and they have their own properties and so forth. What they do is they allow a certain portion of your pension to be used to pay off your mortgage. Some will allow you 60%, and they can finance you for your mortgage. So 60% of your pension, they'll say it's available. They pay the bank. You have a less debt to pay for the bank, and you have a manageable amount that you can pay as your installments. Then as part of your monthly pension contributions, they sort of pay off that money that they finance you with, because they know in the long term, property helps with the money that you will need at the end when you retire so that you can have a comfortable life. The system. So banks don't print money. We know it is the South African Reserve Banks because it's the banks of banks. So they are the ones who print money and they loan money to banks. And banks, just like us, pay an interest. And that interest is called the repo rate. So when you hear the Reserve Bank governor coming in, I think every 2 months, and he says, no, the repo rate is not increasing, or the repo rate is going down, it's basically the cost that banks are going to pay when they borrow money from the Reserve Bank. And what banks do then is they add another, currently the repo rate in South Africa is 3.5%. And what banks normally like to do is add another 3.5% to it. In fact, they do that in most cases, depending whether the repo rate goes down. If the repo rate is 1%, they will add a 3.5. Then what we call prime interest rate then becomes 4.5. So the prime is really catering for them being able to pay the Reserve Bank the interest they owe and also making a bit of money from that. So the 1% goes to the repo rate, the 3.5 is theirs. So what's with this repo and this prime? So we know that in economics, we have the principle of, or the concept of demand and supply. If there's more supply that exceeds the demand, the prices go down so that demand and supply can balance. If there's less supply, then you'll find that, and there's more demand, you'll find that prices will be increased so as to balance the supply and the demand. So the same thing with people demanding money so that they can buy. You'll see that in most cases, when we don't have money, we borrow. So the demand for borrowing is regulated by the interest rate. And why would the Reserve Bank regulate? Because it has an effect on inflation. Inflation is the measure of how much prices are increasing. So if we have a lower repo rate, that means the prime rate, which is the basic interest that banks loan to us, is low. So we will say, yes, I can pay less for borrowing, therefore I'll go and borrow. And then what happens? We have money, we spend. And when we spend, we see the demand is more than the supply, they increase prices. If prices are increasing, then inflation is going up. So the Reserve Bank has been given a target by a government to ensure prices don't increase too much. So there's always a target of prices should increase between 3 to 6%. So they use the repo rate to regulate the demand and supply. So if they feel that prices are increasing too much, they will increase the repo rate. Therefore, that means prime rate goes up as well. So we're paying more for borrowing, and then we start demanding less. And if we start demanding less, sellers say, okay, let's lower the prices. So at least supply and demand can balance. So that's basically the system. And part of that system, I wanted to showcase the very famous equation that we used to do in first year for statistics. But that equation really has three important aspects, and that is interest, payment, and time. So at the end of the day, it's all about time. How soon do you want to pay, or how soon do banks want to be paid? And also, how soon do you want to settle your mortgage bond? So if you want to do it as soon as possible, you don't want your 20 years, then you'll find that they will lower the interest, then the payments will be more. And if you also know generally that if you want to finish as soon as possible, you pay more. So that is basically, at the end of the day, determines how long and comes to time. So the proportionality is always on interest and payment. So one of the reasons why I bring this up is because we get these phone calls that come and say, you having problems with debt, can come, we can help you, we'll give you this much finance, you settle all the other stuff, and you can pay lower. So if you pay lower on, let's say normally the interest rate for mortgage is at prime, which is currently now 7%. Then for vehicles, it's about 11%. Credit cards, you can say about 15%, going to 20%, and then personal loans up to about 30%, and some informal loans can be up to 50% in South Africa. So if the interest rates remain the same and you want to lower my payments, what basically happens is you're going to take longer to pay. Whereas if you say, okay, I want to increase my payments, then you're gonna be quicker for you to pay and finish off. On the one side, they can say, okay, listen, we're giving you this option to pay less, but at this higher interest, all that they are doing is just balancing the equation. Yes, you're gonna pay less, but then the interest is higher. You still end up paying more. So the best situation for us whenever we are negotiating is to try and lower the interest rate. And ensuring that as well that the payments that you pay remain the same, because then that lowers the cost of paying. And if you maintain your payments or increase your payments, then you pay off the interest quicker, and then you're able to deal with the capital portion of the loan quick. One of the things that we just need to accept when it comes to bonds is that the moment we decide we're going to buy on debt, what we're actually saying is, I'm willing to prepare to pay the price of 2 to get 1, simply because of how high the interests are set up in our country. We are one of the countries where the interest rates are high compared to other countries in the world. So it's always advisable that we pay more than the minimum. The minimum is determined using that equation. Let's say 7% interest, 20 years, then you know, let's say you're paying 10,000. The moment you pay more than the 10,000, you are lowering the number of years you're going to take to pay. So it's always advisable that at least 100 Rand more than what you're supposed to pay. That can lower your period of paying by a couple of months. Instead of finishing in 20 years' time, you can probably finish in your 17, 16 years' time. Lawula mentioned when we're looking at having a good score, one of the things to do is to deal with the other debts that we have. The advice that's normally given, and which is good, is start with the small ones, and then focus on the bigger ones. Why? Because when dealing with the small ones, you can quickly pay them off. And then what you can do then is that money that you used to pay for those, you can then add to the money that you are paying for the big ones. And the big one we know is that mortgage bond. So the tactic really is just focus on the small ones, get them out of the way, and then you can then look at the big ones to try and make sure that you finish them as soon as possible. Also nowadays with applying for debt and everything, the banks have looked at what are ways from the normal paying of interest that we can make more money. So there's initiation fees that they charge you. It's just another way for them to make more money. There is service fee that they charge us, another way to make more money. And then the other one is the insurance on the loan. It's something recent that they've added. It's just really another way for them to make more money out of us. You are allowed in terms of NCR to have your own insurer. And it's advisable from my side that you do, because whereas the bank can charge you, let's say, for your bond, let's say 300 Rand per month for home insurance, you can look for a third party that could actually charge you half of that. So you're basically saving on the extra cost that you're paying towards the finance charges. Also, lifestyle. If it means you need to downgrade, you no longer need that Mercedes-Benz, get rid of that Mercedes-Benz, get the money, pay or cut as much of your debt as possible, so that when things start to look good, then at least you have scope. And some of that scope can be used for some of the things that Lawula mentioned in terms of renovating the house and making sure the value of the house increases. Some reliefs, and we know with COVID-19, I'm not going to talk much on the others where there's legal processes, because we do have someone who's going to talk on the legal process. Yeah, with COVID-19, we've been impacted. So what banks have done is to allow for people to negotiate the installments that they're paying. So, I mean, just like us, if we borrow money from your friend and you're going to be some issues on paying it back, you always go to him and say, guy, this month is a bit tight. Can I come again next month? And the friend, okay, fine. I know you're friends, it's fine, sure. The same thing, banks do allow for that, where you can come in and negotiate. More so now because of COVID, because they understand the situation. But even if there wasn't even before COVID, let me say, there was always that option. They just don't mention it, but they actually do negotiate, because the main thing is, as long as they can get back their money, banks are happy. If they know they've given you this money, they've made their money back, they have no issues of sitting with you, negotiating and saying, okay, let's go for this payment, or let's lower the interest. You've been a good customer. Other reliefs is there is consolidation. What real consolidation is, you have your mortgage, you have your other debts, and you're just tired of paying there and there and there and there. What you can basically do is, especially with the others, you can group all your others, whether it's your study loans, you're paying back, your credit card, you can just go get one loan, paid all those, and you just pay one loan. You just focus on one loan and paying off. It's just a simple way of simplifying the installments you're paying. But I think, as I've mentioned before, very key, if you're gonna go consolidation, make sure that you get it at a lower interest rate than your current rate of other loans. There are some ways of trying to work out, because the different types of debts we may have will have different interest rates. There is a method to use to calculate what is the average interest when you take all of them into consideration. And let's say it comes to 17. If you're going to go consolidation route, try to make sure whatever interest you're going to get to consolidate all the others is lower than 17. because then at the end it works to your advantage. Otherwise, you'll find out if it's probably higher than 17, the consolidation ends up being you're paying more than you would have paid if you had just stuck to having 4 others and you're paying them in the normal installment. There's also a process of administration. It's a legal one, but I'll leave that to the legal person. It's limited to a certain amount of debt. When it's certain amount, you can go to administration. But there's also a review process. It's also a legal process, but with a review process, you basically will not be allowed to get further debt. So sort of administration and review, what happens is you go to court, you apply, and then someone will administer your debt payments on your behalf with your creditors. The last one, which is sequestration, is the one that we all want to avoid, where, okay, it's too much, I can't do it. Then the worst thing that happens is they will sell your assets to try and pay off your creditors. So let's make sure we try to avoid the last one as possible, but we do have someone from legal who will share a bit more on that. Some tips on using the system. It's working together. If you are able to meet with some people probably in the same situation, friends, can say, guys, let's come together. Simple thing is trust or scheme that you can form as a group. What is it? It's simply a stokvel. We know we have stokvel, we put money every month, end of the year, go and buy groceries or stuff. Nowadays, we've got people who are doing stokvels for property, got people who are doing stokvels for business. So the same can be done with paying off debt. Can come together and say, okay, let's put this much. Let's cut off some so-and-so's debt first, then we come again, we do the next person. Overall, what happens in terms of paying, it minimizes how much money you can pay. So there's a lot of things that we can find that we're paying insurance on. Some of those insurances we don't really need to really pay, because if you actually look at some of those insurances, how they work is they depend on numbers to get money. They cover you for a risk they are prepared to take that you are not prepared to take, and they make money out of it. So you can sort of do the same as well. Say some things I don't need to, okay, there is the risk, but let me actually take it myself with others. Together we can group up, put money, make sure we have some reserves there, and the interest that we make out of this money that we group, we can do things that we like, and we can even use it to settle some of the debts that we have. There's also leverage. This is more for mortgage. For lack of better word on my side, I'll call it equity leverage. So as accountants, we do bookkeeping. We have our T accounts, our debits and our credits. So when you get the property, we debit your property as an asset, and then you know you have to pay the mortgage. We record that mortgage as liability. So as money comes out of your bank to settle that liability, it becomes less and less and less. As Lawula said, there are things you can do to improve the value of your house. So if you do those things, the value of your house increases. You find that asset, which is your property, it's probably 4 million. Then the debt that you took out, maybe for 3 million, you'll find that's about 2 million. So you have a profit of about 2 million. The banks see this and they say, hey, you know what? We can see you've got this profit margin. Why don't you use that profit margin to increase your lifestyle and get a much better house and so forth? And that works to your benefit, that leverage of about 2 million. Then they can probably finance you for 6, 8, you can get a better house. But very key, as Lawula said, work out what will be the costs if I go for a higher property. Would I be able to afford that? Fortunately, because you have that equity leverage, your installment will not be as much as it would be if you went straight for a 6 million or 8 million house. So that gap of profit works to your advantage. It will lower a bit the installment that you can pay. And if it's affordable, then it's a benefit to you because same thing still applies. You'll increase the value of that house, it becomes more, your liability becomes less as you pay it off. This is actually much better for people who are going into buying small places so that they can rent out. It's a nice way to use that equity as finance to get more property, get more rental, and that's basically where the leverage comes in that you have tax benefits that lower the tax that you can pay and ensure that you have more cash in your hands. But most importantly, it's habits, financial habits. It's coming from an equation I've put there. Income, which is money that you make, should be broken up into savings or an emergency. An emergency fund is fund that money, instead of say saving it for doing something, you can create an emergency fund. What is it all about? It's for hard times like we have now. We know some people have lost jobs due to COVID or their salaries have been lowered. So first thing first, work out what you consider emergency. What is advisable is at least 3 months of your monthly expenses. That is an amount of an emergency. Put money aside, can start small, maybe for 3 years, I'm gonna build an emergency fund, build it. And once you get to that level where you know, okay, this amount of money can cover my expenses for 3 months, you basically start living on that interest that you earn until you need to use that fund for emergencies. If we are honest with ourselves, if you look at how your lifestyle is and how you do things, you'll find out in most cases you are covered for any unexpected emergencies for a certain period. So imagine if you put money for a certain period. With compound interest thing, it can grow into be high. So you can know that you are taken care of. That's why when the banks, they want to offer you these covers and so forth, they always ask you about lifestyle. They always ask you lifestyle questions because they want to see how risky are you. And in most cases, they know most of us are less risk and they know they can make more money from us. So if, as I say again, if they are prepared to take that low risk, we should be able to do it ourselves as well. Have that fund or emergency fund or saving so that you can start benefiting the way they're benefiting from us. Then there is giving. Yep, when you give, it does come back to you to give. And then there is expenditure. So those 3 components should be a structure that we have as a financial habit. Got some emergency on the side, you're giving, it comes back to you more, you're managing your expenses. If you're managing for your expenses, it works to your benefit, especially when it comes to when you're needing money. You heard Lawula said the banks will look at how you spend your money. Is this guy someone who's just having more expenses than his income, or is this guy actually managing his expenses? They can say, okay, this guy is quite good. And as your score, okay, that improves your score rating. As your score rating improves, you can actually have a basis to negotiate and have less interest. And as I said, the less interest we pay, the less of the installment, which works to our benefit. And because we can quickly pay the debt quicker than expected. So that's what I wanted to share. Back over to Olwam as we'll go through some questions.
Thank you very much, Momo. Now we're going to have Varonique Philander, who's the founder and managing director of Child Legal. She's a commercial lawyer and a conveyancer who has a vision to see small businesses grow into sustainable businesses. She has a BCom LLB, which she completed in 2011, from Nelson Mandela University and has been practicing for over 5 years since she completed her articles. Varonique has a lot of experience, and she has taught me a few things, and there's a conversation we had with her which caused me to think that she really would actually add value in this conversation. I know, Varonique, I've sort of ambushed you, but please, man, you are doing this thing every day, so you should have a few comments up your sleeve. You can come on now.
Great. I hope that my bandwidth is going to allow me to keep my camera on the whole time. Good evening, everyone. Thank you so much for that introduction. Oh, yes, you have ambushed me. So unfortunately, I don't have the beautiful slideshow that I would have loved, but I definitely have some value to add. I hope. I just want to maybe put this disclaimer out there because I am a contract lawyer, so I need to cover myself, but I want to sort of just give some context about my background. I started my law journey actually finding myself in the debt collection department at the firm that I started with. I lasted about 6 months there and really realized that debt collection is not for me. This is not why I studied law. And I got some insights from that perspective, but I also come from a background where I understand, the struggle that we have with debt, sort of historically and sort of ingrained in sort of our DNA in a way because of poverty and because of sort of what our parents and their parents had known because of lack and so forth. So I speak from not just a legal perspective, but from experience, having actually seen, from the one side, asking people, when are you going to make payment? And from the other side, as a business owner or entrepreneur who tried to do our own thing, having to dodge and dive 087 numbers. So I want you to understand my context and that I'm not just speaking from a knowledge base, but definitely from an experiential base. Before I get to debt collection and just looking at different options, I want to add to what was shared with regards to the property purchasing as well, if that's okay. I happen to be a conveyancer as well, and I know Owam didn't ask me to add comments with regards to that, but I think one of the things just to add to the presentation that was presented in the beginning, what should also be considered, or the difference that I find most of my clients normally don't consider, is that there's a difference between transfer duty and transfer fees. And so transfer duty is also another expense that needs to be considered. It's basically the money that you have to pay to SARS. Luckily, you only have to pay transfer duty from properties that are valued over R1 million. So that's definitely a big chunk. So I just wanted to add that. And then with the transfer fees, so the table that was shown, that's actually only the monies that go to the conveyance or to the attorney's fund. So when you see your pro forma invoice, you will normally also see some disbursements or expenses, and that normally would include like courier costs or little expenses, but little expenses that actually add up to a lot. So courier cost, municipal certificate, the municipal rates, clearance certificate cost. If, for example, you needed to get an electrician to check the electrical wiring, there would be a certificate that would have to be issued. That certificate would also have to be paid for, and then also like deeds registration costs. So there's a number of different costs that I think should also be added. So I just wanted to add that to the presentation that was shared. But when it comes to debt, I think what is important, and I think from my personal experience and just from other people's experiences as well, before you consider your debt review and your debt administration that was mentioned by Lazola, I think it is probably best to rather speak directly to the credit, credit provider or the business organization that you might be owing money to make an arrangement. I think that is a lot easier, because both the debt administration and debt review processes would include court procedures or court processes. And whenever there's court, there's a lawyer. And whenever there's a lawyer, there's money to be paid. And so that would be from the start process as well as at the end process. So let me make it practical. If you want to go for debt administration, that would mean that you have debt that you're unable to pay because of either having, your income being cut short or not having employment or whatever the case might be. And so you are able to apply for debt administration if the amount of your debt is less than 50,000. Okay, so there's a cap on that. And that would essentially mean that you have to approach a debt administrator. And that debt administrator would almost be like a middleman. That person will be managing your payments. And that would mean two things. It would mean, one, that your debt repayment would be reduced, because now you are trying to negotiate for a longer period to pay it off by. And so that is what the administrator's role would be within that. But then there's a court process to be able to do that. That court process would then mean that there would be a certain judgment or order in your favor to say, okay, you are now under debt administration. And to get out of that debt administration, you would have to there would have to be another order by the court to have been made to say, okay, you've paid up your debt now and everything is clear and the creditors are happy now. And so then there's a rescission of the judgment that has to take place. And then there's another legal process there. So I just want you to understand that whenever there's an order or a judgment, that judgment would have to be rescinded in order for you to be clear completely. And this makes, this becomes relevant because when you go to the Experian and the TransUnion and your credit profile, essentially, you would notice that there's judgments there if a judgment was taken. And how judgments normally work, and this is sort of a different type of, I'm talking about, okay, let me not talk about that yet. Let me first, before I get to judgments. So that's debt administration. And then you also get debt review, that was also mentioned. And that's with your debt counselor. Essentially what the debt counselor comes and does, this would be applicable for people that had debt over 50,000 and you can't manage your payments. And now you go on this debt review plan. And your debt counselor is essentially the one that is writing this debt repayment plan for you. So they structure and set it up for you and basically negotiate on behalf of you with the credit providers. And essentially they will then make the payments. So you pay them, they pay your creditors essentially. Now, the tricky part in that is as well, like if your situation changes, which is very easily possible, now you have a debt review order that was taken because that's also a court process. And now you want to get out of it because you want to purchase a house, you want to purchase a property, you want to purchase a car. And now it's not that easy to get out of it because you would have to get all of, if you can only get out of it if you've paid all of the debt and your creditors are happy. And then also when that judgment is rescinded. So you have to go back to court and actually get the magistrate who had issued that, well, not that particular person, but basically a magistrate in that court where you had initially been, to actually now say, okay, you clear, you are almost rehabilitated in a way, and you are able to pay to cover your debts and so forth. And so that would have to also include a rescission process for that debt review process to come off your name essentially. And so those are the options, but it is my view that it's probably easier to speak directly to the credit providers to try and make some sort of a payment arrangement if possible, so that you can cut out the middleman. I don't know, that's sort of what I think is probably better. What you should not do is what people normally do, which is when the credit providers stalk you and phone you and you try and dodge and dive them, and then eventually you get letters of demand, and then eventually you get a summons, right? And then that summons, later on, you're just wishing it away and you're thinking, well, they're not going to get hold of me. You should not ignore the summons. When you see a summons, you should be aware, like you should be awake, okay? Because the summons is not going to go away when you ignore it. And that's important to note, because it is in that process of summons where they actually get default judgments against you because you're not doing anything. So if you've ever received a summons, you would notice in that summons, they're basically giving you notice that they're instituting legal process against you. And now you have the opportunity to either defend the matter or concede and say, okay, let's try option to act, right? But if you ignore it, you're basically saying nothing, and they are now able to proceed with the matter further in your absence. And that's what you don't want, because that's when the judgments actually now get taken and actually put on your credit profile. And once that happens, a judgment of that nature is basically valid for 30 years. Okay, for 30 years. I'm about 32 now, so 30 years is a long time. And so you don't want that, because you will have to make sure that you pay off that. So you will have to go and negotiate either with your credit provider again. But now it's different, because now you have legal costs and you have interest that also is now added to the capital amount. And now the amount is a lot more than what you would have paid had you negotiated from the beginning. Okay, so I just want you to understand that. And that definitely plays a role in terms of whether people want to give credit to you, because essentially you would be blacklisted. So a lot of people want to get judgments off their name, but they don't understand that it means that you need to actually institute a process, which is a rescission of judgment process, which is a process that is actually a legal process that takes place in court. And what we need to actually do that process, or to institute that application, is basically a letter from the creditor stating that you've paid up, or that there's no longer a judgment debt. And therefore, the court would then see that, they would see the confirmation letter, and then they will remove that judgment. So I think in a nutshell, that is some of the comments that I want to add. It is like, I think, Lazola had mentioned about the habit that needs to change. I say this because I've been there. I'm in the process of reforming as well. And I think it's really, really important to, take these type of opportunities to take notes, to be able to see how we can make better decisions. Yes, we might not have known previously, but now that we know, what are we going to do about it, and how are we going to make better decisions for our futures? Because, it was mentioned, I'm not sure if it was Lawula or Lazola that mentioned it, but when it comes to protecting looking at wonder when you're no longer here, debts don't disappear when you are no longer here. I think a lot of us don't realize this because we don't speak about death per se, and in our families we might not have our ducks in order, like wills and your last will and testaments and things like that. I know I've seen it like with grandparents and so forth. And I think it's very, very important that we do understand that your liabilities don't disappear. Your creditors still have a claim against your deceased estate. And what that mainly means that if you have assets, like if you have properties and so forth, those properties would essentially have to be sold if creditors put that claim in, because your heirs only get paid out after all of the expenses has been covered. So I think it's not just a question of whilst you're still here. I think it's definitely a question of how do we change our perspective? How do we make better decisions, not just for ourselves, but for our children and for, for the legacy that we want to leave behind? So I think, that's very relevant as well. So yeah, I think that's my 2 cents there, or I hope that was of value. And I'm free to answer any questions.
Thank you very much, team. This was truly exceptional. It makes me want to actually play this song.
Bafuna imali andikho, bafuna imali yabo andikho, susani la ndoda esangweni ndinamali, bayandibiza andinamali.
That's it. I just wanted to say that. I'm just enjoying myself here. Okay, questions. I see that Kairas was asking about if we could actually share the slides. I don't want them to share their slides. Kairas, I think we have this recording on YouTube. You can just follow the link that I've given you. And then I've also shared the contact details of each of the contributors, so that you have access to them, and hopefully that you guys are able to find some amicable sort of, conversations and amicable decisions amongst the 2 of you. I think also Ongole asked something about, I've been told that Standard Bank is moving towards hyper-personalization when determining the interest rate to give to a potential customer. And then Lawula was supposed to answer, is FNB also moving towards this, or is still a generic approach? Lawula, do you want to have a take on that?
Yeah, but from our credit space, I don't know if we'll call it a hyper-personalization on our side, but I did write back to Gule in answering. So I think from our side as the bank, what I know is all credit is actually tailored to your risk factor or your category in your risk. So that's how we base it. So from time to time, credit teams will meet up, redraw new models into actually tailoring to allowing more, let's say, higher risk customers, but depending on the appetite of the bank. For instance, last year we had a lower number because of COVID of customers actually applying for bond. So that took the bank from all banks to the drawing board to actually give an ease when giving credit. But again, the variables and models which they perform in actually giving that credit. So based on the risk and how they actually identify you.
Okay, thank you very much. And then Izzy Elimnyama is asking Lazola to make a practical example on consolidation. Secondly, the ease of getting credit without a pay slip, e.g. as a business owner. What are the odds? How easy or difficult is it to get credit from that context? Oh, this is Ulavel.
Okay, maybe I can just jump in as well since I work for a bank for that from Ulazol. Yeah, basically for all businesses, if you're going to apply to a financial institution, you need to have your financial statements in order first. So just like as a normal person who works, you need a bank statement and your pay slip to verify. Similar, your bank statement and also your financial your balance sheet and income statement for the business for you to be granted a loan. So again, it always talk to the tailored risk factor. So how risky is your business? How much income do you make? So the bank will make a determination based on that.
Okay, thank you. So Lazola has provided a response, Lavela, but Lawula also gave you a very good response. Thank you very much. I see there are no further questions. I want to actually, because we are left with 5 minutes, I would like for Lawula to have his sort of concluding remarks, and Lazola would follow, and then Veronique, and then hopefully would be able to close in 5 minutes.
Okay, thank you, Olam. Basically, what I can say is that check your credit, check your debts. As Lazola mentioned, start from small to high in actually eliminating all of them in order for you to get that dream home. And actually, even not just your dream home, but your investment properties that you might have to buy. So one thing I think I missed on my presentation was also the cheaper way of actually buying a new property is when you buy it off plan. So for instance, when the development starting and they'll tell you, look, 2-bedroom, we're selling it at this 450 for a 2-bed. So it might be cheaper because the value it's realized maybe just on completion. I've seen it, experienced it, so I know it works. And also the advantage of actually doing off plan. So once they start building, you can always pull out. And it just costs you probably a deposit of 3,000 to 5,000. So it's not much of an expense to go for. So, but what I can say is that make sure you clear off your debt, not just for property, but for your own sanity as well. We're living in tough times and they might be longer. So let's all try and work towards clearing that up. Yeah.
Thank you. Thank you. Thank you, Mr. Buso.
Sibange umhlaba.
I see there's a last question that came through with regards to what credit facilities would you recommend for graduates, assuming that they do not have any kind of credit record. But we don't have time now. If anyone can conclude using that sort of question as at the back of your mind, Lazola.
Thanks, Olam. I was actually just typing a bit on that. I would say to Zola, it really depends on how much you can afford. And also with an NCA, there's a limit on how much banks can give to you, also based on how much you can afford. That's really the ruling. Lawula had mentioned about the 30%. So banks, they really need to stick to that. Otherwise, they're going to be in trouble if they don't stick to that. And the reason why I'm saying it really depends on how much you can afford is because different types of facilities have different interest rates. So as I said, the cheapest one is for your house. The next one is finance. It's financing. It's vehicle finance. Vehicle finance currently now is around 10 to 11%, which I checked it on the weekend. I was sort of impressed. Was the last time I was looking at it, it was higher than that, but it's around 10 to 11. Then you have your credit cards. Then that goes to about, say, between 18 to 20. And then we have your personal loans. Your personal loans can be about 27 to 30. And then we can have your loan sharks. They can go up to 50%. So it's really just seeing how much you can afford and say, okay, I'll go for this facility. But yeah, at the end of the day, it's really about how much you can afford because of NCA. NCA makes sure that those people who provide credit, they first work out how much you can afford, then they give you based on what you can afford. My closing is really on the habits, especially that income equation. Have an emergency fund, manage your expenses. It gives you peace of mind, knowing that you have some emergency on the side and as Lawula had said, especially to Lavela, when they look at if can they provide you credit, they look at what is your habits. If they can see that you're someone who's good at managing your expense and is able to pay, they are happy to give you money because they know they can get it back. As long as you can show to them that they will get back their money, they will be very happy to give you money. So for me, good financial habits. Yeah.
Okay, and I see the last question from Z. Z, we didn't prepare for FLISP, but Veronique, can you provide your closing remarks?
Okay, great. I want to get my video going. Just on Z's point, we didn't prepare for it, but it's my is that it must be a first-time home owner or buyer. You must have, it's income based. So if your income is less than about 22,000, from 35 to 22,000, and you have children, you might qualify. But this is just very high level. My closing remarks is prevention is better than cure. Now that we know better, let's do better. I think if you are a graduate or somebody just starting out and you have the luxury of not have made some of the mistakes that we might have or I have in the past, then that's great. I think there's so many people sharing content, sharing their stories on YouTube, on Twitter, on so many platforms. We have now the knowledge or at least access to hopefully some of the information that can help us to make better decisions. Stay out of court if possible, because it costs money. And so, yeah, all the best, and let's keep positive.
Thank you very much, ladies and gentlemen. Let me first also again apologize that Unongoleko Mwazi could not be here. She has flu. So yes, she lost her voice, and as much as I have a hoarse voice, she has a worse one. So I had to step in. Thank you very much to Lawula for assisting us. This really came through a conversation when I was up in Joburg, I think about 2 weeks ago. We had a bit of a catching up session, and then I realized that this is the actual conversation that we've been meaning to have. And then Lazola Momo, a constant financial support, someone that can speak clarity on issues of money and how the system works. And then Varonique, Philander, all your legal issues, really, you really want to give them to Varonique. When you go to buy new properties, as a conveyancer and things like that, please speak to her. I've provided all their contact details on the chat section. We'll have this conversation on YouTube so that you can actually have access to it. So just search for Lawula Buso on YouTube and we'll have it, or just look at our platforms, we'll put it up there. Thank you very much, everyone. Enjoy the rest of your evening, and God bless.